What if I told you the market usually shows signs before it crashes, but most people ignore them? In this video, I'll show 5 hard-to-miss signals that preceded major crashes, the real data behind them, and how professional investors interpret these signals today. Here's the roadmap: yield curve, credit spreads and CDS, leverage and margin debt, volatility via the VIX and options flow, plus market breadth and liquidity. Markets are noisy. No single indicator is perfect. Good analysis blends multiple signals and context: macro, policy, and liquidity. Use these as probabilities, not certainties. The yield curve plots interest rates from short-term to long-term. Normally, it slopes up. When it inverts, short rates exceed long rates. An inversion often signals expectations of weaker growth or tighter policy, and it compresses bank lending margins, tightening credit supply. Before 2000 and 2008, both 10Y2Y and 10Y3 MIR inverted first. Lead times vary, months to over a year. The signal raises recession odds. It doesn't time crash magnitude. Here's what the data actually says. Inversion is a strong recession indicator, but not a countdown clock. Pros watch both 10Y3 MIRs and 10Y2Y plus bank lending trends. Use it as context, not a solo trigger. Credit spreads are the extra yield over treasuries. CDS spreads are insurance costs against default. When spreads and CDS jump, the credit plumbing tightens and financing costs surge. Into 2007-08, corporate spreads widened sharply as mortgage and interbank risks surfaced. CDS volumes and spreads surged, signaling stress before the worst equity declines. Contagion runs through collateral and margin. Higher haircuts trigger calls, selling begets more selling, and liquidity vanishes. Pros scan IG, HY, and sovereign CDS. Broad, persistent widening is the red flag. Margin debt is money investors borrow against portfolios. High rising leverage can amplify declines. A 5% drop on heavily margined positions can cascade into forced selling. Margin debt spiked into late 1999, 2000, and rose into 2007. Correlation exists, though academics debate causality. The mechanics matter more than the exact peak date. Pros track leverage, financing terms, and lending volatility, not just headline margin totals. If leverage is climbing while liquidity thins, vulnerability increases. The VIX is often called the market's fear gauge. It reflects implied volatility from S&P 500 options. Spikes generally accompany or precede panic sell-offs, especially when liquidity is thin. Watch skew and put demand. Hedging pressure can feed volatility. In March 2020, VIX surged as liquidity evaporated. The spike was both signal and reaction. Combine VIX with other signals. On its own, it's noisy. Breadth tracks how many stocks participate in a move, the AD line or the share above moving averages. Liquidity is about trading depth and spreads, how easily large orders can execute. When indices rise on a handful of megacaps while breadth deteriorates, fragility builds. In stress, liquidity vanishes and even large cap names can gap lower. Deteriorating breadth plus thinner liquidity elevates downside risk. Here's a simple checklist. Is the curve inverted? Are credit spreads and CDS rising broadly? Is margin debt surging? Has VX moved above its long-term average? Is breadth deteriorating while indices make new highs? Pros layer on central bank policy, fiscal strain, geopolitical shocks, and thin liquidity windows like month and quarter end. When multiple indicators flash together, risk rises. One signal alone is rarely enough. Translate signals into position sizing, hedges, and liquidity, not panic. .com 2000. Soaring valuations, margin debt peaked, and breadth collapsed even as the index hit highs. The curve inverted ahead of the recession. Timing to the equity peak differed. 2007-09. Mortgage and interbank stress drove spreads and CDS higher, foreshadowing the equity collapse. Liquidity froze as margin calls and collateral haircuts spiraled. COVID 2020 was a sudden exogenous shock. VIX spiked and liquidity thinned almost instantly. Not all crashes follow the same signals, but clustering matters. Know which indicators matter most for the regime you're in. Summing up, multiple indicators aligning raise the odds of trouble. One signal alone is insufficient. Context and discipline are everything. Practical steps: rebalance risk, check diversification, build a cash buffer, consider hedges or stop-loss rules, and consult a licensed advisor. We've linked a TLDR and data sources in the description. If you found this useful, subscribe for more data-driven market explainers. Drop your questions below. Which indicator surprised you? Stay curious, stay disciplined.